What is going on, YouTube? It's Matt Fairclough. Welcome to Mentorship Monday. Here to join me as my co-host is, as always, the Justin Frazier. Justin, come on in.
Hey, what's going on, Matt? How are you today?
I'm awesome, man.
So, Matt, this question is from Denny, and Denny is reading your book, Raising Private Capital.
Thank you, Denny.
And so Denny has a follow-up question about something on your book, and he's saying that, you mentioned you got a loan from your in-laws, maybe a HELOC for one of your first deals, and so he's trying to do the same thing. Denny has $200K HELOC on his one house. Okay, it's a rental house. He's got a $200,000 HELOC on there, but really thinks he needs $500,000 to $600,000 for the deal he wants to do in the market that he's in. He's in Southern California. So what he wants to do is pitch his dad on opening a HELOC on one of his dad's paid off rentals. So this obviously can get a little sketchy. We're dealing with family, we're dealing with rentals and money. So really Denny's question is, how does he structure this? Borrowing from his parents, from their HELOC, should he give him equity? Should he pay him a premium above the interest rate? How does Denny go about structuring this kind of deal?
Got it. Okay, great question, Denny, and thanks, Justin, for summarizing that. So here's what we did, and here's what maybe we do it the same way. When we first got started, my parents and my in-laws both had real estate. My parents, their primary residence was free and clear, and my in-laws had a rental property free and clear, right? So what we did when we first got started was we took those properties and we put a business equity line of credit on them, a BLOC, right? And now what that means, the difference is a HELOC is something that my in-laws would have gone and put on themselves, called a local small community bank and said, hey, I've got this free and clear real estate and I want to put a home equity line of credit on it. Fair enough, right? So they would have gone and then they would have gotten the checkbook themselves and they would have said, okay, how much is this for? A couple $100,000, whatever. Okay, let me write Matt Fairclough's, real estate company a check for I'll go to lend them money direct, and we would have taken that loan money and put it to work ourselves with them as the conduit of that. Now I could have negotiated a markup. So at the end of the day, Denny could go to his father and say, okay, I understand the HELOC's likely going to cost you 2.5%, 3.5%, somewhere in there. I'll pay you 6%, Dad, and have him pay his dad a yield spread above what the HELOC was costing him for the deal. That is one way to do it. It's not what we did. I'll get what we did in a second. But that is a way for his father to maintain some control. And for him to maybe, even if the father's a real estate person and whatnot, maybe he can vet the deal that Denny gets himself into to make sure that Denny's making the right calls and maybe look out for his son while also helping him out, right? That is one way to do it, is have the father keep the checkbook and write the checks to Denny. That's not what we did. What we did was the BLOC, and the BLOC worked like this. You got this free and clear real estate that's owned by, Denny's father, right? Denny's father stepped up and was a guarantor on a loan that was made up to our LLC. Okay. So our LLC was the borrower. Okay. The borrower was us. Our company got vetted. Our credit got checked. Everything got checked on us. And then they stepped up as the guarantor with the real estate that got collateralized. Right. So that loan got put on their property, and it was a loan to us with that property's collateral. So then we got the checkbook. We got to write checks for deals we want to do. We got the rights to say, we'll buy that property, not this one. The monthly bill for the real estate, the interest came to us, not my in-laws or whatever. We had to write those monthly checks, and we were 100% fiscally responsible for that. Now, the level of trust that it takes to get to that second equation is a lot more than it takes for the first one, because for the first one, if God forbid, Denny, slips up and doesn't write a check to his dad one month for that monthly HELOC payment, his dad can make the payment himself. Now, I'm proud to say that the entire life of those lines of credit that we had, we'd never missed a payment. And because, you care, it's on your in-law, it's on my parents' house, my in-laws' house, right? I do love these folks. So I do want to, and also it's just the right thing to do, as a custodian of other people's money in general, whether it's family or not, that is a way better way to do it. I would not even think of proposing that BLOC situation to someone who's not immediate family, because the level of trust it has to be off the charts for you. And I talk about that in the book about people that like and trust you because you're you, not because you're some awesome real estate investor. They just, you are who you are. So
is there any recourse? Is that why you're saying the level of trust has to be up there, because there's really not much recourse there?
Well, yeah, no, there's 100% recourse, because if you don't, the recourse is on them. If you stop making that monthly payment on that BLOC, the recourse is for them to go get that collateral, which is like,
right. So the person who has the collateral has no recourse against you.
Correct.
Right. It's their property's on the line, and they can't really come after you in that instance, right?
No.
Now, do they have to be part of the business, or how does that work?
They have to be a sponsor on the loan. Yeah, they just have to be a sponsor on the loan. That's it.
Okay.
Yeah. They didn't have to, I mean, it was crazy. They didn't have to be part of the LLC. They have to be part of anything. They just had to say, I'm willing to sponsor a loan for this LLC over here. So, but we had to go to closing together, but that was it.
Okay. Because they have to sign all the docs. Now, is there any difference? Do you know difference in rate or fees with the BLOC versus the HELOC?
It's the same. It's like,
Same.
What I've seen, I have a HELOC on my home and I have a BLOC, and the rates are around the same. It's like, prime plus, it's not much. So, yeah, so it's not that big of a deal.
Okay, so let's say they don't want to go the BLOC route. That's a great concept and very interesting. But let's say I'm not going to go BLOC route.
Yeah.
And I'm going to go HELOC because maybe it's my dad, or maybe it's my neighbor, or maybe it's someone that invested in a past deal and they don't want that. They want a HELOC. So how do you recommend, let's say you're going to borrow from me and I've got to pay 3.5% on that HELOC. How do we structure this so that it makes sense for both of us, and that I'm protected, but also making a little bit, but you're able to do what you need to do with that money?
Two ways. Number one, you got to pay a yield spread above what the cost of capital is, right? So if it's costing you 3.2% in interest, I should be paying you whatever I negotiate with you, like 6, 7, 8, 9, 10, 13, whatever rate of return that you and I can figure is fair, given the risk factor that you're taking on the property, on the deal. And I might not be able to give you collateral, meaning I might be buying a property with a first mortgage, and so you can't step in second behind them because they maybe are not going to support. They're not going to be willing to have you sit behind them or whatever. There may not be collateral on the property as well, which is another reason why you want to have the checkbook yourself. You could protect.
So this is more like a personal loan. I'm loaning you personally
with a JV agreement. Personal loan, JV agreement may work. I would probably be willing to pay upside on profit, meaning I'll pay you 6%. But I'll give you, if I'm doing a fix and flip or a rental deal or whatever, I'll give you a cut of the profit above that, above that rate of return, above that flat interest rate to yourself. We did a deal in Philly. We built 3 townhouses. We had a primary mortgage. I had an investor lender also. I could not give them collateral on the property and a mortgage. So I paid them 8% on an 8% return on their capital plus 12% of the profit on the deal.
Wow.
Yeah.
I'll take that. That's a good deal.
Yeah. They ended up walking out, but we kept 88% of the profit on the deal.
Right.
But that investor ended up walking out of that closing on the selling side. Once we had sold all 3 of those townhouses, they ended up making something like 28% on their money in 10 months.
That's fantastic.
It's sick.
Right.
I mean, yeah.
Especially if someone has that money just tied up in the property. It's one thing if you're using that HELOC and you're constantly doing loans, that's one thing. But if you're approaching dad and dad's just got this money tied up in equity on his property, why not put that money to work? And I love that. So he doesn't have to give an equity share, but he can do a profit share. So he's not bringing dad in as an owner. He's giving dad a profit share. So maybe he can pay dad his dad's payments, right? So the dad's not out of pocket for anything, but now there's some upside on the end. Depending on what the deal is.
He's controlling interest. He's giving him equitable interest, but it's not. Right. But controlling, it's not that his dad has voting rights, but his dad does did a cut of the profit.
Right.
You could do it that way too. Right? So that's what paperwork's for. That's what lawyers are for. They can help you structure all this kind of stuff. But it really goes down the real estate equity conversation really goes back to figuring out who's in control, and most importantly, above everything else, compensating that investor in a monthly check that covers them. What that HELOC is not going to drag down their expenses. You're giving them a monthly check that's going to exceed the cost of that HELOC, so that they can make a little bit of cash flow, maybe with some upside with you on the back end.
Love it. Love it. Really good stuff. Really good breakdown there.
Yeah, it's a great way.
HELOCs, borrowing from family, giving profit upside. I mean, what's not to love? It's all good stuff.
Making it rain, right? Cool.
Absolutely.
Yeah. Awesome, Denny. Great question, Denny. And I love this stuff because I think that it really helps. I love the concept of putting free and clear real estate to work in our business in real estate. It is, if it's structured the right way, it's a great way to help people really get a lot closer to financial freedom. So, one quick bit of trivia: did you know how much? Last time I checked, how much real estate in America is owned free and clear?
I have no idea.
So 30% of primary residences that people live in, not all real estate, not like the King of Prussia Mall and stuff like that, but like 30% of primary residences are owned free and clear.
Wow.
Isn't that crazy?
It's a lot of equity tied up.
Yeah. Could get
Put it to work. Put it to work, America.
Yeah, man. Let's do it to it.
That's awesome. That's great. Another great episode, Matt. Thank you. Thanks for all the info. And guys, stay tuned for next week. We'll be back here doing it again.
Cool. Justin, here we go. Thanks for watching, guys, and have a great and profitable week.